we can almost just get into the scalp without even seeing price, can't we? Because the basic idea is always the same. What you're trying to do is you're trying to trade the candles, the red line and the blue line as the same thing. So obviously, the challenge you've always got as a trader is how far and how wide is value. Well, this is a challenge that's been a challenge for the institutions forever. You know, it's a challenge that anybody that's tried to design an algorithm in the room here has probably found since the beginning of time is how big is big. The idea is value is always going to be a, the idea is that there's always going to be value for buyers in a downtrend. There's always going to be value for sellers in an uptrend. That's what happens. So trying to find how far is value means that sometimes you've got to wait for that arbitrage narrative to unfold. So sometimes it's good to see it happening. So you can start to recognize, for example, that the arbitrage unfolded here. So you can see the blue line's going up, the blue line's going up, the red line's going down, the red line's going down, and then they both go down at that point there. But obviously, that would be an arbitrage sell. But obviously, the price is already selling. But you now know that the arbitrage has just been done at that stage. So you can start identifying how wide is wide. It starts allowing you to make some calculations at that stage. How wide is that value for that arbitrage to kick in there? So obviously that's one of the things you can start looking at. Now obviously when you see that sell, you know, depending upon how far it goes, you still might be able to grab a piece of that trade, right? But obviously you know you're late to the party, so it is what it is. I mean, if you wait, you wait. If you try and catch it on the way up, you might be too early. So there's always going to be a price to pay, isn't there? Everything we do, there's a price to pay. You know, if you're too early, you're reducing your probability. If you're too late, you're reducing your price edge that you're getting on the trade. So there's always a price to pay. Now, obviously, sometimes, on the odd occasion, we can get in early and we don't have a price penalty. That's when we talk about arbitrage. We can get in early and we don't have a price penalty. So this was a value trade, but there was a price penalty because we wanted to wait till the value showed up and then we took the sell, right? So there's always going to be that aspect to trading. Now there was one that you can see that stands out as a possible arbitrage. You can see that the red line's rising here and the blue line's rising and the candles are rising. You can see, but it's incredibly small volumes. Because it's incredibly small volumes, I don't think there's going to be a big trade in this trade here. So because of the incredibly small volumes, you're obviously looking at that saying, well, this is going to be a sell, but it's not a, the volume suggests it's not an arbitrage. So you're going to be hunting for the liquidity during that phase, aren't you? There was one arbitrage that stood out very, very clearly. You may well be able to spot it. It was this one here, wasn't it? You can see that there is very large volume and the red line's going up and the blue line's going up. So in other words, you're getting a price advantage and a value advantage at the same time. Is that not the strongest combination we can ever ask for? You're getting a price advantage and a volume advantage and a value advantage at the same time. This is a benchmark without even seeing price. Would you agree with that? This is a benchmark without even seeing price. This one right here. That's the one that if I can do one trade a day, that's the trade I want. Make sense? So did it turn out to be a good trade? Did it turn out to be a good trade? It was only $1,400. It was only $1,400, wasn't it? So it was a perfectly good trade. It was actually better than a good trade. It was an arbitrage. No, we actually prefer the red line to be going up, Miguel. We want the red line to be discounted, which is different from going down, yeah? We want the red line to be discounted, and it was discounted, but it's being discounted is different from being going up or going down, yeah? Everybody gets that? So we would prefer the red line to be going up, so long as it's not going up faster than the blue line. And it's got to be discounted. It's got to be discounted. That is the perfect sell trade on oil, isn't it? We've got a price advantage and a value advantage and a volume advantage on the same trade. If you can do one trade a day, that's the one you want to be on, but that's benchmarking, isn't it? There isn't any other trade that's had that type of perfect combination, is there? There's not any other trades on the screens that have had that exact combination into a new swing high, a new day high, a new level high, a new wholesale price level, and all the various other things at the same time. That's great news. But this is good because, you know, being able to know what a brilliant benchmark looks like and feels like, you might argue, but there could be better benchmarks than that, because that is still fading a top edge, and I accept that that is still fading a top edge. I agree with that. But obviously, as you come up into that top edge, there's going to be other elements, isn't there? There's going to be other elements that maybe fall into place. You're still going to be searching the order flow. You're still going to be looking for the tape. You're still going to be waiting for the Voltic. You're still going to be waiting and looking for the order flow to line up with that bit of business, aren't you? It's not just straightforward. There it is there, boom, I'm in, and that's your trade done and dusted. There's got to be other elements. There's got to be something else that we can actually be paying attention to. And if you waited for the Voltics and the leans, you got it. You got as much Voltic and lean as you could ever imagine that you could ever want, guys. It was a great, easy Voltic lean trade narrative. There it is there. Look. So the sell trade was at 1350. There's the 1350 trade there. You see there's a very, very large lean comes in just at that same price there. Massive, massive delta getting absorbed into that price on a single block trade, literally a single block trade. You've got your lean, you've got your sell, and then you get the transition trades coming in here. You can see the sellers come in, the book sellers come in. You get the perfect transition and you make a huge profit. A huge profit. Obviously, it would be better if it was at lower prices because we're still taking that gamble. As you know, we've just mentioned it. We're still taking that gamble onto our books. And you know what? Sometimes that's what happens. Sometimes we get that narrative. And we just have to accept that that sometimes is the problem child, isn't it? Sometimes that's what happens. So, brilliant sell on oil. Absolutely crazy good. And that is what an arbitrage looks like. But remember, that was actually visible without seeing price, wasn't it? Without seeing price, that trade was actually on your screens, screaming at you to get that business done. Now, obviously, that's caused the oil to flip badly, well, quite considerably, and then obviously what's happened is you've then started to look for that obvious flip trade, you know, around about 20 past 14, you're starting to look for that obvious flip trade. Well, you can see some obvious trade ideas developing up here. Is there anybody that can't recognize that there has been a change in the environment here into a buy trade on oil? Is there anybody that doesn't see that change in the trade? Anybody that doesn't see that change in the trade? So, what would an arbitrage look like in this environment? Well, we kind of know what an arbitrage would look like in this environment, don't we? It would obviously be a buy trade. It would be the red line dropping into a red candle. Yeah, the red line dropping into a red candle. The blue line dropping into a red candle. So basically any candle that was red here or here could be an arbitrage buy, or any candle possibly even here or here or here or the next one. Any of those as a buy trade could be buys, but usually that's always going to be used. That's already being arbitraged out. It's already happened, you know what I mean? So you don't always get the opportunity. So looking for that buy trade, did you see any red candles? There's your red candle right there, isn't it? There's your arbitrage candle right there. So there's your red candle that you're looking for. There's your arbitrage. Now it turns out that it actually retested that arbitrage, didn't it? It actually gave you a test, but that test was expected because they were all going up. We've got a lot of value to buy this. And what happened to the buy trade? Well, It wasn't exactly spectacular. We went 85.40 to 85.70. We made $300 on an arbitrage. $300 on an arbitrage. And then you saw the arbitrage sell, unfortunately, coming in this candle. Do you see it? Now, it's not a sell in terms of the value, but it's a sell in terms of the arbitrage. So obviously, we don't take necessarily the short sell unless we were keen on short selling, but we certainly use that arbitrage in that blue candle as a walkaway. See how the red line's rising and the blue line's rising a lot faster? Well, that's an arbitrage sell. So for long at that stage, there's no way we hang on to our long position. We just book our profits and we say, thanks very much, and we walk away. We book our profits and we stroll. We canter off down the park, don't we? Great trade. Lovely outcomes. Doesn't get any better than that, guys. Does not get any better than that. Beautiful. So I will be watching for that oil buy. That seems to be the way that the JRT's setting up just now.